Hello, I'm Criscuolo, market strategist at the New York Stock Exchange, and this is Market Storylines. Every week, we're here to keep you up to date on the key trends and events driving global markets. As we record on Thursday afternoon, let's dive into this week's Market Storylines. This week marked the end of September, the end of the third quarter, and the beginning of the fourth quarter. As the great voice of horse racing Dave Johnson would say, "And down the stretch they come." If you never heard him, check out his 2006 Kentucky Derby call when Barbaro won. Now back to the markets. September has historically been the weakest month of the year, down an average of 2% over the past 10 years. We bucked that trend this September though, with the S&P up 3.5%. Tech was a big driver of that gain. The sector gained 7% in the month, and the ICE Semiconductor Index rose 11%. Communication services, mainly Alphabet, utilities, and consumer discretionary were other sectors that were strong. Discretionary was a mixed bag though. A big part of the gain was from Tesla, which was up over 30%. GM and Ford were also higher. On the other hand, many of the travel, leisure, and restaurant stocks fell 2 to 10%. On the other end were materials and consumer staples. Chemical stocks weighed down the materials sector, while retailers, food, and beverage stocks brought the staples sector lower. As for the third quarter, the S&P 500 was up 8%, but the small cap focused Russell 2000 did even better, up 12%. The Fed starting a rate cutting cycle was a big driver for that outperformance. Another small cap index, the S&P 600, was up 9%. Besides including more companies overall, the Russell 2000 also includes non-profitable companies, which are excluded from the 600. The fact that the Russell outperformed the 600, as well as the S&P 500, points to investors moving into riskier parts of the market, as we saw sharp rallies in some of the popular thematic trades like nuclear, quantum computing, and digital asset treasury companies during Q3. Now, let's turn our attention to this week. The federal government shutdown was the main news item, but it's had limited impact on the market so far. It was widely expected, and unfortunately, it's happened before. It causes some marginal downside, but the biggest effect, outside of the toll it takes on lives of government workers, is on the publication of economic data. We're seeing more delays in that than in a Long Island traffic report. Weekly jobless claims were supposed to come out today. That was shelved. Tomorrow was supposed to be the always important monthly non-farm payroll report. That is being shelved as well. Assuming the shutdown continues, a lot more economic data will be delayed. Data from private sources is unaffected, however. The ADP employment report this week showed the economy lost 32,000 jobs in September, while August gains were revised down from 54,000 to 11,000. Another data source that is updating is the Challenger job report. There was good news and bad news in that one. The good news was that announced cuts fell to 54,000 from last month's 86,000, and last September's 73,000. Now the bad news. It's likely job cut plans are going to surpass 1 million for the first time since 2020. Also, hiring plans announced in September fell 71% from a year earlier, the weakest September since 2011. This is usually when the hiring data in this report jumps, as retailers start to boost seasonal staffing. But that's not what this month's data is showing so far. M&A continues to be a big driver. BlackRock's GIP business is reported to be close to a deal for utility AES for around $38 billion, including assuming about $30 billion of debt. Berkshire is buying Occidental's OxyChem business for $10 billion. And the U.S. government continued to be in deal mode as well and got one in before the shutdown when the DOE announced it was taking a 5% stake in Lithium America Corp. The administration has also said it's looking to do a lot more of these types of deals across industries. So far this week, the S&P is up about 1%, while the small caps are lagging a bit, but still higher. Healthcare is easily the best performing sector. That strength was triggered by significant news flow from Pfizer's announcements with the White House around drug pricing, as well as U.S. R&D and manufacturing investments. M&A activity is also helping support the sector and providing fuel for the catch-up trade, as the group has severely lagged the market overall. Tech is also among the best performing sectors on the strength of, you guessed it, semiconductor names. Hardware and memory names are also putting in a solid week. On the other side of things, energy is the worst performing sector on the back of oil's recent weakness. Concerns over supply gluts and OPEC production increases are weighing on the commodity. Speaking of commodities, gold rose to $3,900 to hit another all-time high. Financials are also down as rates have moved lower and a few recent consumer-focused bankruptcies have increased concern over the health of the consumer and credit markets. IPO delays from the shutdown are also not helping the sector. Now, looking ahead to next week, thankfully it was going to be a relatively light economic data calendar, but your guess is as good as mine as to what data we actually get. The next CPI print is in 2 weeks, October 15th, so there's still hope for that one. The minutes to the last FOMC meeting are scheduled for Wednesday, and the University of Michigan sentiment report is set for Friday. OPEC will meet over the weekend, with reports suggesting another increase in production. Now, probably the most importantly, the 2025-2026 NHL regular season starts on Tuesday, October 7th. Let's go Islanders! Remember, you can watch Market Storylines on tv.nyse.com or on the NYSE YouTube channel. You can also listen every Friday on the Inside the Ice House podcast feed. Thanks for joining me. I'm Criscuolo. We'll talk to you again next week.